Pause the chart for a moment. Do not read the price. Ignore the noise. Focus on the candle itself. That long, violent spike straight up is not normal market behavior. It is not organic buying pressure. It is a signal that something broke briefly inside the system. Silver did not climb to $83. It jumped there in an instant, and markets only move like that when liquidity disappears and algorithms take control. 1 minute silver was trading below 80. The next, it flashed above 83, and before the market could even breathe, it was slammed back down. A $9 swing in a single session is enough to rattle even experienced traders. If you are new, your first instinct is fear. You assume the rally just ended. You assume the smart money sold the top and left you holding the bag. That reaction is exactly what this move was engineered to create. Veterans see something very different. If you lived through 1980 or survived the chaos of 2011, you recognize this pattern instantly. This was not a collapse. It was a stop hunt, a deliberate, calculated move executed in a thin holiday market when volume is low and the order book is fragile. Ghost week is when liquidity dries up, and when liquidity disappears, price can be pushed anywhere for a brief moment. This was not about discovering a fair price. It was about flushing leverage. The machines forced price higher to lure in late buyers, then ripped it lower to trigger forced selling. Fear was the weapon. Volatility was the tool, and weak hands were the target. In this emergency breakdown, we are going to expose what actually happened beneath that candle. We will show why the paper market behaved like a broken casino while the physical market barely reacted at all. The screen looked chaotic, but the foundation did not crack. This was not the end of the move. It was the opening test. If you are still calm after hearing this, type 1 in the comments. If you want the rest of the analysis, subscribe now, because the next chapter explains exactly who got trapped, who stepped in to buy, and why this shakeout may have strengthened the trend. To understand why price collapsed so violently, you have to ask a simple question. Who was buying at $83? It was not the patient capital. It was not the institutions. It was not the people who accumulated silver quietly at 30, 40, or 50. The buyers at 83 were the late arrivals, the chasers, the traders who saw a vertical move on a Sunday night and convinced themselves that speed meant safety. Most of that money was leveraged, 10 times leverage, sometimes more. And leverage always leaves a fingerprint. When traders buy late with borrowed money, they protect themselves with stop-loss orders. These stops are not hidden. They are mapped, clustered, and statistically predictable. The market knows where they are because human behavior never really changes. When silver pushed above 80, the majority of those stops sat just below 75. That zone was a magnet. Once price began to roll over, the selling was not emotional at first. It was mechanical. Large blocks of futures hit the market at the highs, pushing price lower into thinner liquidity. As price slid through 79 and 78, nothing dramatic happened. But once it touched the stop zone, the cascade began. Thousands of automatic sell orders fired at the same time. Margin calls followed immediately. Positions were liquidated not by choice but by force. That is why the drop felt like a waterfall. It was not sellers changing their mind. It was leverage being erased. The market was cleansing itself. And while that panic was unfolding on the screen, someone else was waiting. The same players who sold into the spike were already positioned to buy back lower. They did not chase strength. They harvested weakness. This is how leverage is rinsed out of the system. It is not fair, but it is how unstable markets reset before they move again. What matters is what happened next. Price did not keep falling. It hit the mid-70s and demand appeared immediately. That demand was real. It was decisive. It absorbed the forced selling and pushed price back higher. That tells you the drop was not a rejection of silver. It was a transfer of ownership. The gamblers were removed. The market survived. Now look at the candle again, but this time through a technical lens. What printed on the chart is known as a shooting star, sometimes called a high wave candle. A small body with a long upper wick. To most traders, that wick looks like failure. It looks like rejection. The market tried to go higher and got pushed back down. And in isolation, that interpretation makes sense. But context changes everything. Changes. A shooting star at the end of a long, exhausted trend is dangerous. A shooting star at the beginning of a breakout formed during a low-volume holiday vacuum tells a very different story. It signals excess speed, not structural weakness. The market moved too far too fast and needed to release pressure. That wick is the release valve. Despite the violent drop from the highs, the close is the data point that matters. Ignore the spike. Ignore the panic. Compare where we are now to where we were last week. Silver closed the previous week in the low 70s. After all the chaos, it is still trading near the high 70s. That is not failure. That is strength disguised as disorder. What you are likely to see next is not another vertical move. It is digestion. Price needs time to process a $9 range. Expect consolidation, expect frustration. Silver may drift between 75 and 80 for several sessions, chopping back and forth in a way that destroys momentum traders and option buyers. This is not an accident. Sideways markets exist to exhaust impatience. The key level has already revealed itself. The bounce occurred almost exactly where last week's breakout began. Old resistance turned into new support, and it held on the first test. That is textbook behavior. It confirms that buyers are defending higher ground. This phase feels boring compared to the spike, but boredom is constructive. It allows moving averages to catch up. It allows volatility to compress. And compression, not excitement, is what fuels the next expansion. The market is not weak right now. It is catching its breath. While silver was thrashing violently, something else was quietly sending a message. Gold barely moved. It dipped, slightly held its ground, and remained anchored near all-time highs. That contrast matters. In real breakdowns, correlations rise. Everything sells off together. That did not happen here. Gold stayed calm, and calm assets do not coexist with broken systems. Gold is the anchor in the precious metals complex. When it holds, it tells you the monetary backdrop has not changed. Debt is still excessive. Confidence in fiat systems is still fragile. Nothing about today's action resolved those problems. Silver simply ran ahead of itself, as it always does. It is the high beta sibling. It overshoots on the way up and overreacts on the way down. This is the cost of participation. Silver does not offer smooth trends. It offers acceleration. If you want the upside, you accept the turbulence. That turbulence is what taxes leverage and rewards patience. Physical holders understood this immediately. They did not panic. They did not rush to sell. An ounce remained an ounce regardless of what flashed on a screen for a few minutes. This brings us to the most important divergence of the day. While the paper price collapsed, the physical market did not follow. Dealers did not slash prices. Premiums did not vanish. In some cases, they widened. That behavior tells you everything you need to know. Physical sellers were not convinced the move was real. When paper prices swing wildly, dealers protect inventory. They understand that the volatility is artificial and temporary. Selling physical metal into that chaos is a guaranteed way to lose money, so they step back. Supply tightens. That creates a floor. This is why paper crashes do not always translate into real-world discounts. The drop existed on screens, not on the street. The disconnect is not a flaw. It is a signal. It tells you which market is unstable and which one is grounded. Volatility shook the roof. The foundation remained intact. The next piece of the puzzle is volume, or more accurately, the lack of it. Ghost Week strips the market of depth. When traders step away for the holidays, the order book becomes hollow. Prices do not move smoothly in hollow markets. They fall through air pockets until they hit real demand. That is exactly what happened during the drop. There were no buyers layered between the high 70s and the mid 70s. Price did not slide. It fell. And when it reached the breakout zone from the prior week, demand finally appeared. That reaction was immediate and aggressive. This was not retail buying. This was industrial and institutional interest stepping in where it was always planned. Large industrial users do not chase price. They wait. When silver spiked above 80, it created anxiety, not enthusiasm, for procurement desks. But when price snapped back into the mid-70s, it became an opportunity. Hedging programs activated, buy orders were executed, paper selling was absorbed and converted into physical demand. That is why the bounce was so sharp. The market found its floor because that floor mattered. Old resistance at 75 became new support, and it was defended on the first test. This is not random behavior. It is structural. What you witnessed was a transfer. Speculative positions were forced out and stronger hands replaced them. This is how trends mature. Weak ownership is replaced by committed ownership. Each cycle raises the floor. The result is a staircase pattern. Last month, the floor was near 65. This week, the floor appears closer to 75. Higher lows are not exciting in the moment, but they are the architecture of sustained moves. The volatility was loud, the signal was quiet, and the signal says the bid is real. Now we need to talk about the volatility tax, because volatility is never random punishment. It is a fee charged specifically to leverage. If you were trading futures options or margin during this move, you paid that fee in real time. Stops were hit automatically. Margin calls arrived without warning. Positions were liquidated, not because the thesis was wrong, but because the structure was fragile. That pain was engineered. It is how the market enforces discipline. Physical holders paid nothing. They did not need to act. They did not need to decide. An ounce remained an ounce. What they gained instead was clarity. For a brief moment, the market exposed its hand. The flash above 80 was not noise. It was a preview. It showed where price can go when pressure is released even temporarily. This was also a stress test of conviction. When price exploded higher, it did so with ease. When it fell, it required force, size, and coordination. That asymmetry matters. It tells you where resistance truly lies. Energy builds in the direction that requires the least effort. At the same time, open interest was reset. The market had become crowded with leveraged longs. The boat tipped and the excess weight was thrown overboard. Now the boat is stable again. Clean decks invite stronger capital. This reset is constructive. If silver had marched straight toward triple digits without interruption, the eventual correction would have been violent and destructive. By flushing leverage early, the market reduced systemic risk and extended the life of the trend. Volatility feels like chaos in the moment, but in trending markets, it is maintenance. It tightens weak bolts, removes excess pressure, and prepares the structure for heavier loads ahead. The move looked brutal. The adjustment was necessary. Now pull your attention back and look at the bigger signal the market just sent. This move did not come from the outside. There was no interest rate shock, no currency collapse, no geopolitical headline that rewrote the rules overnight. The dollar stayed relatively calm. Bonds did not implode. Equity markets did not signal systemic fear. That tells us something critical. This was not a macro event. This was a structural purge. When markets break because fundamentals change, they stay broken. When they break because positioning becomes unstable, they rebound quickly. What you witnessed was a failure caused by excess weight, not a loss of belief. The longs were not wrong. They were simply overextended. The market did what it always does in that situation. It forced them out. This is why the setup for January actually improves after a move like this. Leverage has been flushed. Open interest has been reduced. Weak hands have been removed. The path forward is cleaner. Institutional capital does not want to buy chaos at the highs. It wants to buy resilience after stress. A reset near 75 is far more attractive than an untested vertical spike above 80. Big money waits for confirmation. Violent shakeouts provide that confirmation. They prove that price can absorb pressure and still hold elevated ground. That resilience is the signal long-term capital responds to. Pay attention to the psychology shift. Just days ago, silver at 65 felt expensive. Today, silver near 78 feels frustrating. That reversal in perception is how bull markets mature. Expectations outrun price, and that creates fuel. This was not a warning shot. It was a cleansing. And markets that have been cleansed tend to move with far more force in the direction that remains. Now we need to confront the part of this move that unsettles most traders, the long upper wick. That wick looks brutal. It feels like rejection, like the market slammed the door at 83 and shoved silver back down in seconds. Traditional technical analysis will label this as resistance, and in the short term, that is accurate. Markets remember pain, and pain creates supply. Traders who bought near the top and survived the drop are now emotionally trapped. When price approaches that level again, many of them will sell just to escape at break-even. That selling pressure does not disappear overnight. It has to be absorbed. This is why 83 will not fall easily on the next attempt. The market needs time to process what happened. Expect a grind, not fireworks. Expect silver to move sideways between 75 and 80, churning in a way that feels pointless and exhausting. This phase is designed to break patience, not portfolios. Moving averages need time to rise. Volatility needs time to contract. Energy needs time to rebuild beneath the surface. This is the most psychologically difficult part of a bull market. The excitement fades, the headlines quiet down, and doubt creeps back in. Many investors exit here mistaking consolidation for failure. History shows the opposite. Strong trends pause before they accelerate. The wick did not kill the move. It mapped the battlefield. It showed exactly where sellers appeared and exactly where buyers defended. That information reduces uncertainty, and reduced uncertainty leads to faster future moves. Most importantly, the lows held. Buyers protected higher ground. Conviction did not break. The next breakout will not be loud. It will come when boredom replaces fear and when attention disappears. That is when markets strike. Now let's bring time back into the equation because timing is everything at this stage of a trend. We are approaching a critical window, the end of the month and the end of the year. These closes matter far more than any intraday spike or collapse. Daily candles scare people. Monthly candles move institutions. If silver holds above 75 into the monthly close, it will register the highest monthly closing price in history. Read that again slowly. Even with all the chaos, even with a $9 intraday collapse, the market is still on track to print a historic signal. That single data point outweighs every emotional reaction from today. Large funds do not care about wicks. They care about closes. They care about trends that survive stress. A strong monthly close tells pension funds, endowments, and asset allocators that silver is no longer a speculative sideshow. It becomes a legitimate allocation. That is when real size enters the market. This is also why the violence likely happened now and not later. If leverage had not been flushed before year-end, it would have created instability during January inflows. The market preemptively cleaned itself. That makes the runway safer for larger capital to land. Understand the psychology here. A close near 78 feels disappointing because you briefly saw 83. But zoom out 1 month. Not long ago, 78 sounded impossible. This shift in expectations is how wealth is built quietly, not loudly. The battle into the close is simple. Bulls defend 75, bears try to break it. As long as price holds above that level, the breakout remains intact regardless of how ugly the path looks. This is not about predicting the next dollar. It is about respecting the signal the market is preparing to print, and that signal, if it holds, changes the game going forward. We have reached the final chapter, and this is where perspective matters more than prediction. What happened today was not comfortable, but bull markets are not built on comfort. They are built on survival. If you made it through a $9 swing without panic selling, you passed the first real test of this cycle. The final verdict on that shooting star candle is simple. Context decides meaning. In exhausted markets, it marks a top. In newly awakened markets, especially during thin holiday liquidity, it marks a reset. What we witnessed was not a reversal. It was a liquidity test. The market tested 83 and found sellers. It tested the mid-70s and found aggressive buyers. Now it knows the range, and knowing the range is how trends mature. Here is the strategic takeaway. First, audit your exposure. If today made you physically uncomfortable, you were carrying too much leverage. Reduce risk where necessary, so volatility cannot force your hand. Strong positions are positions you can hold through noise. Second, respect the 75 level. That is the line that defines the breakout. As long as it holds, the larger trend remains intact. Third, stop staring at intraday candles. The next few sessions may be dull, choppy, and frustrating. That is not danger. That is preparation. The real opportunity lies ahead. January brings fresh capital, rebalanced portfolios, and institutions that care about monthly and yearly signals, not emotional spikes. The market just removed weak ownership and raised the floor. That combination is powerful. Remember this. The most profitable trends feel the most uncomfortable at the beginning. You are not late. You are early in a market that is transitioning from ignored to unavoidable. Today's volatility was the price of admission. If this analysis helped you stay grounded, make sure you subscribe, like, and share this video so more people can see through the noise. And tell me in the comments how you handled today's move. Staying calm is not easy, but it is how capital is built. The rug pull failed, the trend survived, and the next chapter of this market is just getting started.